Wondering what could move your portfolio this week? 3 signals will set the tone: the Fed's language, earnings guidance, and fresh inflation prints. Markets are highly sensitive to policy direction, and even small shifts in expectations are rippling through rate-sensitive sectors. Investors are also weighing whether corporate guidance can justify recent equity strength, while new price and consumer data could reshape views on growth and funding costs. Together, these forces are steering positioning across equities, credit, ETFs, and even crypto. Here's what's different now. A quarter-point swing in expected policy rates is driving outsized moves in housing, small caps, and long-duration growth names, reminding everyone how tightly valuations hinge on financing conditions. Profit dispersion is widening as management teams turn more cautious on input costs and pricing power, so stock selection matters more than index momentum. Policy signaling remains front and center, with Kevin Warsh a focal point in Fed discussions as markets recalibrate timing, magnitude, and balance sheet strategy. And cross-asset linkages are getting more episodic, meaning correlations can snap in and out around data drops, reducing the reliability of diversification right when you need it most. Watch the central bank tone closely. Speeches, minutes, and interviews can nudge terminal rate assumptions and reshape the yield curve. A subtle tweak on labor or balance sheet runoff can boost banks and value one day, then favor utilities or high growth the next. The curve matters too. A steeper 2s10s can lift net interest margins and risk appetite in credit, while a flatter profile often tightens the screws on lenders. Earnings quality will do the heavy lifting. Beyond beats and misses, listen for commentary on pricing, wage pressures, and inventory. With consumer spending around 2/3 of U.S. GDP, updates from retailers, services, and travel are real-time reads on demand. Tech and industrial capex plans will signal where the next leg of productivity and margin resilience may come from. For a practical edge, map scenarios before the headlines hit. Stress test your holdings for a 25 basis point shift in the policy path and a different curve shape. Tilt toward balance sheet strength and durable cash flows, and be selective in rate-sensitive plays. Use staggered entries and hedges around data prints, and don't rely on yesterday's correlations to protect you today. Stay nimble, stay data-driven, and let guidance and policy tone guide your risk. Read the full article at finlitica.com.